S&P's up $1 right now. Capital allocation, diversification. You ready for this?
Speculation. Yeah, go ahead.
Let's take a look. I think you guys are going to like this one. We do market measures every day. This one's sponsored by the SIBO. We have a bunch of events coming up that are also sponsored by the SIBO. We're going to do a 4-part webinar series with the SIBO, and they are going to be also matched up with Julia Spina's book. And I think you guys are going to love it. There's going to be a 4-part webinar series that I'm doing, 1 hour each. And then we're going to do 4 live shows around the country. Jamal and I'll do them with 8 different segments. It's going to be just a fantastic teaching experience, and we've got the SIBO to sponsor it, so they'll be free all over the country. So we'll give you all the information coming up very soon. Mm-hmm. Just behind capital allocation, diversification is the second step in portfolio management. By having buying power in trades with diverse underlyings, we can help reduce the chances of being wiped out by outlier moves. In general, lower correlation underlyings provide more diversification, but as no 2 underlyings are perfectly correlated, all diversification helps. Let's look at how extremely simplistic diversification, trading the same strategy mechanics but in 2 different underlyings, can help ensure portfolio health. One thing I'll say that's been interesting about both Bat's career and my career is that neither of us have ever been put in a situation where the market has taken us out of the business. Is that fair to say?
True. Oh, 100%.
Yeah, me too. Now, a lot of people have, and a lot of my friends have been in situations where, the market has taken them out.
Sure.
A big move, 2 big positions, things like that. Mm-hmm. But the nice thing is that
stubborn, a lot of times being stubborn.
Yeah. The nice thing is, though, listen, that doesn't mean we haven't had some really ugly experiences, because everybody has.
Of course.
But myself, Pete Momat, Tony, Liz and Jenny, who all came from the floor, Scott Sheridan as well, we all spent, multiple decades doing this. None of us have ever been in a situation where we've been wiped out by outlier moves, which is pretty remarkable. It really is. And I think it's a testament to some of the stuff we've done here on Tasty, but it's also a testament to, the fact that we've all stayed diversified with respect to strategy, and this is almost defensively by default, not even understanding all this, diversified by strategy and diversified by size and underlines. And so, and those are probably the 6 of us that I'm trying to think of. Am I missing somebody here?
I don't think so.
I don't think so. That would have multiple decades of just prop trading and everything else.
You say the Momat? I don't know if you said the Momat.
I said Momat.
Okay.
I said Pete, Scott, you, me, Liz, and Jenny. I think that's the 6 of us. And I know there's others, but I just, on the Tastyworks side, there's a lot more, but we'll see.
So there's only 6 of us on the Tasty Live set. It makes us a very unique and small subset, probably very valuable to the company.
You're a lot less valuable than you think you are. Everybody's replaceable. But every time you get that little thing going on in your head where you think you're valuable, just remember.
Well, the Overlord. I got it. If somebody want to know why you're called the Overlord, bingo, ding, 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 ding. Go ahead.
So let's go to the next slide. Beth, please. The study. We considered the portfolio of a variety of hypothetical traders who did nothing but sell 20 delta 45-day to expiration strangles. That's all you did. Some managed trades at 21 days, while others held their position through expiration. Each trader had a fixed percentage of their total buying power they were willing to allocate, from 15% to 90%. This is just like we did the other day, but this is just a heavier level. Some trades worked exclusively in one underlying, some traders worked exclusively on underlying, while others allocated their buying power up as evenly as possible between 2 underlyings. Next slide, please. So using 16 years worth of data in SPY, Amazon, TLT, and silver. Now, if you're wondering why we did this, because we wanted an index, we wanted a high flyer, we wanted bonds, we wanted a precious metal. And we looked at this from 2005 through 2020. For each management style and underlying pair, we recorded the smallest percentage of allocated capital that resulted in a busted portfolio, no longer having the buying power to make the next trade. And lastly, we observed for each trader the frequency which with they sustained losses in excess of their allocated capital. Are you good with this, Pat?
So far.
So remember, for each management style, we recorded the smallest percentage of allocated capital that resulted in a busted portfolio. And then lastly, we observed the frequency at which you sustained losses of their allocated capital.
We're looking at something from the dark side here, right? I mean,
yeah, this is a dark side trade. Okay. So basically, the smallest percentage of allocated capital resulted in a busted portfolio. Let's go to the next slide. So this is the minimum allocation to bust portfolio at expiration. And this goes, so I guess it doesn't really matter. Let me think about this for a second. Would it matter what portfolio size is? Don't think so.
I mean the percentages would be.
Yeah, I don't think so.
Right? I mean, they would be linear.
Yep. So, SPY, Amazon, TLT, and SLV. So looking at these numbers here, this is the minimum allocation that would bust a portfolio, which means that you had not enough money left to do the strangle in the next expiration cycle. Mm-hmm. And that's it. Basically, that's what this is. And this is looking at, basically looking at everything against one another.
Got it.
What does this mean to you? I'm not sure. I'm trying to decide.
I don't know. I mean, are you going to put 55% of your portfolio in SPY? Probably not at this time. You had at one point, 100% of your portfolio in OEX.
Yeah. I'm trying to decide if what my takeaway is, because I can't think about it, right? Let's go next slide.
Well, Amazon, a lot more volatile than anything else, I guess is the way I could look at it, right? Because look at the percentages.
And if you manage it 21 days, well, obviously, if you manage it 21 days, everything's going to change because the outlier risk goes away. Mm-hmm. So in certain underlyings, you never had a situation where you would have busted out of the portfolio in SLV and TLT. And what it did is it changed dramatically the allocations. It changed dramatically the minimum amount. When you manage it 21 days, you basically reduce the risk dramatically, right? Mm-hmm. That's what this is saying.
Yep.
The risk dropped off by about 60, 70%. In some cases, 100%. Both the bust risk.
Yep.
Again, the takeaway from this slide is easy compared to the last slide, which basically says you essentially take about half the risk off the table by managing early. Let's go to the next slide. Okay, so this was the frequency loss. So, because if you remember, going back to slide 2, Beth, if you go back to slide 2 for 1 second, this is the last bullet point on slide 2. Which said, this is slide 1, slide 2, next one. I'm sorry, slide 3. I apologize. So lastly, we observe for each trader the frequency with which they sustain losses in excess of their allocated capital. That's what this slide is. The frequency with which you sustained a loss in excess of your allocated capital. Now let's go to that, slide 5. So frequency of losses in excess of your allocated capital. And I think this is important. So if you managed it 21 days, the frequency with which you did the SPY in excess of allocated capital, 0.03, In Amazon, it was 0.65. TLT and SLV was 0. I mean, Amazon a little bit more.
Yeah.
And TLT 0 and SLV basically, the point here is that Amazon maybe once, but everything else, in that 2018, I think.
Right. And it's not the $98 or $100 stock that Amazon is today. Amazon, remember, was probably
4,000,
right. Market's pretty
3,000.
wide and big movements. Right.
Yeah. Basically saying that if you imagine 21 days, the frequency, this is why we've survived for so long, because the frequency with which this happens is virtually nil.
Yep.
You imagine 21 days.
Yep.
Okay, that's good. Because like you look at the other slides, you're thinking, oh man, this can happen a lot. But the frequency with which it happens is really, it's less than, it's a fraction of a percent. Let's go to the next slide. So the takeaways, both simple diversification and managing at 21 DTE showed large reductions in risk metrics observed. Yes. Especially so for ETFs. The mixed underlying portfolios with 21 DT management considered, other than those that included Amazon, they had 0 losses in excess of buying power over 16 years and did not go bust with even 90% of constant capital allocation. So it's interesting. The only one that put us in any jeopardy at all over that 16-year period was Amazon.
Right. Right.
So ETFs, anything else, pretty much nothing.
Yeah,
so,
and you would. I mean, that's not surprising that an outlier. I don't know if I would have picked Amazon, but
no, it's not surprising. But they didn't cherry pick it. That's the point.
Right. But an individual stock, if you had to say what's going to make you, go bust, would it be an individual stock or an ETF? I'm quite confident, even in your accelerated age, you would have said an ETF because it has diversification with 500 or 2,000 stocks. Whatever the case may be.
And then even in a diversified account, there is a chance of simultaneous outlier moves of multiple underlyings. It remains important to keep some capital reserve to recover from those potential losses. We're way under those numbers. And I did forget to mention our very own Frankie, who also never blew out.
and JJ. There you go. All right. So
my God, I forgot about JJ.
Thanks, JJ.
Thanks, JJ. Yes, he's another long lifer.
Now there's 8 of us. The pool just got bigger. My net wealth, my valuableness went down.
And Steve wants me to say that he never did either. Although
there were times when he was account debit, he just didn't know it.
Although there were times at the blackjack table when I think he was debit.
Fair enough. Beautiful. Can we take a quick 90-second break? I mean, can I do that?
Of course.
Obviously. We'll be back in 90 seconds. Mr. Scott Sherry next. Peace.